So in today's episode, I'm asking what I think is a very important question. Is Canada propping up condo investors to prevent condo prices from falling? And I think this is a super important question, whether someone's an investor, whether they're a first-time buyer, or whether they have kids who want to be first-time buyers tomorrow. I think it gets at the heart at what role housing plays in Canada. Do we live in a country that wants housing to be affordable, or do we live in a country that wants home price to be as high as possible? Do we have bank regulators that have certain rules to protect our banks and our economy from bad lending and speculative lending, but change those rules for certain sets of buyers during certain conditions in order to keep prices elevated? And I think that's what the key issue is today. That's what we're going to try to unpack, and we're going to kind of go through some of the dynamics that I think are going on that I think we need to be mindful of, because these are the first signs, and some of these dynamics are going to actually probably get worse in the future. So we need to understand what policymakers are doing, what bank regulators are doing, and what governments are doing in response to some of the dynamics I'm going to talk about today. So just to kind of unpack what I'm talking about, when I'm talking about propping up condo investors, I don't mean every investor. I don't mean everyone who has a condo right now and is renting out to a tenant. I'm talking about a very specific group of investors, specifically people who bought pre-construction condominiums 3, 4, 5 years ago, who are scheduled to take completion now. And to unpack what I mean by that, in 2020, I wrote a blog post on our blog, movesmartly.com, titled "Why Investing in a Pre-Construction Condo Could Cost You Money." And the point of that post was literally what I was seeing as a very massive disconnect between pre-construction prices and resale prices. At the time in downtown Toronto, the average price for a resale, an existing condominium, was about $1,000 per square foot. Pre-construction condos were selling for closer to $1,500 a square foot. Now, of course, these are not apples to apples comparisons. Some of the existing resale ones would be older. But even when we looked at, recently completed condos, pre-construction condos would be selling anywhere from 30 to 40% more than very similar recently completed buildings. Now, of course, one concern is, well, what happens if the existing resale market doesn't continue to appreciate? These pre-construction condos, the only reason investors are buying these pre-construction condos at these elevated prices is because they expect existing condos to keep going up rapidly in value. Well, what happens if they don't do that? What happens if they stay flat? Well, would the investor now have a condo that they pay for that isn't really worth what they paid because the resale market is a lot lower? That was one concern I raised. And it was interesting because I got invited to speak to a panel of a group of, I'll just say, policymakers. I think it was right around that time. And I raised this concern as a material risk in the market. And I'll never forget that the reaction from most was that there is no concern. I mean, their only concern was a lack of supply, that we're not going to build enough condos or houses. And there is, and these risks that I highlighted are not out of the, just Toronto specific. When you have a housing market that is dominated by investors who are paying what are probably very speculative and aggressive prices, that market is always vulnerable to a collapse because the expectations exceed sort of the reality. We saw this in Dubai. We saw this in many US housing markets. So it's not that there's anything unique to Toronto. I mean, these are dynamics that have played out in the past. Policymakers weren't concerned. And I think we're going to start to see if they are going to be concerned over the next little while. The other issue I raised in this blog post was, of course, well, what if rents don't catch up to justify a purchase price of $1,500 a square foot? Do these investments make sense? So there were some vulnerabilities, obviously, back then. So we're going to talk about one specific condo that, interestingly enough, recently completed downtown Toronto, that actually sold right around the time that I kind of published that blog post. That's 57 Mercer Street, downtown Toronto, completed first quarter this year. So what I basically did is I kind of looked at, most of those units are basically being leased. So I just took a look at 20 of the most recently leased units, just a broad range of prices, to get a better understanding of what buyers paid for those units, and to look at what they're renting them for and what their cash flow looks like. So when we look at the actual prices, the average price for those units was about 855,000. Average price per square foot was about 1,539. The average unit size is about 555 square feet. So that's specifically at 55 Mercer. Now, what is the average price, or what do prices look like in that neighborhood downtown in the King West neighborhood? This is from condos.ca. So the average price is actually slightly higher, about 870,000, but the average price per square foot is 1,029, so significantly lower. And the average unit size is 845 square feet. So very big difference. Again, these are not necessarily apples to apples comparisons. Some of those units in King West were built 15 years ago. But again, obviously a very big premium to resale prices. And I think that is the first thing we need to keep in mind. Now, next, I looked at the cash flow for these properties. And that, of course, is just looking at the rent minus the investor's expenses. And we can kind of pretty easily see both. I mean, we know what the unit's rented for because those listings are on the MLS. And then we can estimate, we can see their purchase price. We can, assume they put a 25% down payment. And we also have some insight into the maintenance fees and property taxes based on the units that are listed for sale. So for the average unit, if the average price of 855,000, the investors are short about $1,700 a month, which means that their mortgage payments, their maintenance fees, and property taxes are about $1,700 a month higher than their actual monthly rent on that property, $1,739 to be precise. So a very, very big disconnect. That assumes today's rates and a 25% down payment. Now, if rates drop to 4%, those numbers look a bit better. They're down to about $1,260. But again, obviously a pretty significant shortfall between carrying costs and their rent. Now, the next important question is, are those condos worth what investors paid for them? And this is a tricky question to answer because there aren't a lot of sales. There are a bunch of units that are listed for sale. Most of them have not sold, virtually all, except for one. We have one sale in that building, and it was a unit that sold for $700,000. It was originally purchased for roughly $830,000, I'd say. Which results in basically a 19% decline in value, which probably lines up with what, realistically makes sense as a market value. So this building would be worth more than the average price of $1,000 per square foot, but not quite $1,540 per square foot. So if we assume that prices are down, roughly 20%, the next question, of course, is, what normally happens when someone overpays for a home, when they paid a particular price and then they're about to get their keys and that home or condo isn't worth what they paid for them? So in a normal world, if I went out and bought a condominium for $800,000, I was planning on putting $160,000 down payment, so 20%, I would get a mortgage for $640,000. Okay, that is sort of what would normally happen, assuming prices don't change. But if prices fall 20%, well, then the 800,000 condo I just bought is now only worth 640,000. So how does that impact my mortgage? Well, the banks basically come around and say, okay, listen, we'll give you a mortgage. We'll give you 80%, but we're going to give you 80% of what the property is worth, not what you paid for it, which means that they would give me a mortgage of 512,000 rather than 640, which was what I was originally hoping for. So if we actually just look at how these numbers break out, I would have to come up with an extra $128,000 because my original 160 that I was planning on putting down as my 20% deposit, well, that's kind of covering the decline in value. So that's not actually helping me buy the unit anymore. That's just covering the shortfall. I would need to come up with an extra $128,000 to actually get a mortgage. It's effectively a capital call. Like you're basically being requested to come up with more money to cover the fact that you just made a bad decision and the prices fell. Now, what's I think interesting thing about this is that, probably at 55 Mercer, we had, 543 condos that were underwater, that were likely worth less than what the investors paid for them. And normally in that scenario, you would expect to start to see some distress. Some people can't get mortgages, some people who default, some challenges with the project closing. But that didn't happen. We didn't see that. It was just blue skies. Everything closed. Investors took their keys, started renting them. And I think one of the reasons why we didn't see any distress has to do with some changes with respect to the way banks are underwriting mortgages. And what appears to be happening right now is that the banks are assuming that the condos are worth what the investors paid for them rather than actually appraising them at today's market value. So a condo that was bought, for example, at $800,000 could get a $640,000 mortgage even though the unit's only worth $640,000 in today's prices because the values have declined. So this effectively means that someone can get a loan that is 100% of the value of the property, because it doesn't matter that they put 20% down as a deposit, because that's kind of gone because the values have declined by 20%. Which means that they basically have a zero down mortgage. They have a loan that is worth 100% of what the property's worth. In theory. Now, in the industry, we call these blanket appraisals, which is, of course, different from a traditional appraisal. A traditional appraisal would basically value the property at today's prices. And in that scenario, as I said earlier, the investor would have to come up with extra cash. With blanket appraisals, banks aren't doing that. They're basically kind of closing their eyes and saying, yeah, we'll just pretend the property has not declined. We'll just assume it's worth what you paid for it. Now, a couple of important things to kind of note here. Can we prove this for a fact? I mean, the challenge, of course, is no, because we do not have insight into every individual appraisal. We don't even necessarily have insight into the mortgage that each unit owner has. Most of the mortgage registered on these properties are registered at the prices that the investors paid, but that doesn't necessarily mean that's how much they borrowed, right? But I'll say a couple of things to that. I mean, number one, if you speak with any credible person in the industry, which I do, virtually everyone is saying the same thing, that this is happening. And in some projects, it's not as significant. In some projects, the decline from what the investor paid to resale prices is only 10% or 7% or, not quite as significant. So they're turning a blind eye to a, not as significant a discount. Probably something like 55 Mercer is probably at the higher end in today's market, where the difference between the prices paid and market value is closer to 20%. But again, every credible person in the industry that I've spoken with is basically saying, yeah, this is happening. It's kind of being swept under the rug, but this is what's going on. This is how they're closing. The other thing to keep in mind is that we have to just have some logic and some basic understanding of the likelihood of certain things happening. The likelihood that out of a project of 543 units, running into no problems when the values have declined by 20%. So investors need to cough up an extra 100 to 150 to 200,000 is low. I mean, we would expect that some of those people don't have that money. The likelihood that these people all qualify under the bank's government stress test, also quite low. We would expect to see some distress. And again, we haven't seen any, which suggests there's something going on. I mean, banks are kind of turning a blind eye, changing the rules for these properties, for these investors to presumably protect values. So why are they doing this? I mean, partly because banks have a vested interest. In many cases, it's not just the banks that are giving the mortgage to the investors. The banks are actually, in many cases, lenders on the construction financing. So they have an interest in seeing things go as smoothly as possible, so the builder can kind of pay back their loan to the bank for the financing of the construction of the project. Beyond that, banks, of course, are heavily invested in mortgages in the housing market. They're invested in kind of keeping home prices elevated and condo prices elevated. rather than seeing any decline in values, because that obviously impacts their portfolio, the assets that the mortgages are secured against, right? So banks, of course, have a vested interest to do this. And to understand sort of what the issue is, we have to ask ourselves, well, what happens if like 150 of those owners couldn't get a mortgage and they basically just said, you know what, keep my deposit, I'm kind of getting out of here. Now, what happens to the investors is another issue. They're still responsible, but what happens to the project is a bit complicated, and it really depends. I mean, uh, in theory, basically the builder would need to have enough capital to pay off their debts, to register the building, in order for the projects to proceed. If they don't, they needs to be able to sell those units. But selling those units, of course, is not so easy when you have 150 you need to sell in a short period of time. You may not be able to sell them on the open market because they'll look distressed. So there are a lot of challenges with these projects. And when we look at what happened during the US financial crisis, many projects actually failed. The buildings couldn't close because the investors just walked away from their deposits. So the kind of project effectively collapsed and then just had to be resold. Now, that is an extreme scenario. If a high number of people just walk away from their deposits and can't close and can't get a mortgage. In some cases, the builder may take some of the properties into their own under their own books, sell a portfolio of them to some other investors. There usually be some sort of workaround, but at the end of the day, it's a massive potential issue, and there is a risk that the project fails depending on how many investors can't get a mortgage. So, I don't want to make it sound like regulators doing what they're supposed to do is a rosy scenario. There are obviously a lot of downsides, social and economic consequences of projects failing. So I would understand why regulators might want to prevent that. But here's the problem. I think when we had our banking regulator, Peter Rutledge, who's on BNN, and he's asked about the role that investors are playing in the housing market, he basically said that secondary buyers, the investors, they're making investments to generate a return. That's a free market economy, more power to them. Now, we have to understand something about this free market economy that our bank regulators talk about. Now, for starters, I mean, housing is not a pure free market economy. I mean, governments have regulations typically to protect homeowners, households, renters. We have rent control specifically for these purposes. So it's not a completely free market economy. But what governments and banking regulators are doing now is something a little bit different. They're bending the rules and changing the rules, not to protect homeowners or renters, but to protect the bad investment decisions of investors, effectively to protect them from any declines in the future, and of course, to protect the builders as well. And this is a massive problem as well, because what this introduces in our society is moral hazard. And moral hazard is the situation where investors are more willing to take on higher and higher risky investments and speculative investments because they don't bear the full cost of that risk. So what does that mean in the housing market? It means that the investors who are buying pre-construction condos get all of the benefits when things go well, but when things don't go well, they have the banks kind of covering their butts and helping them ensure they don't lose money, right? So this is partly why we have such a speculative culture in Canada. I mean, our own prime minister indicated recently that house values need to retain their value. This is obviously not a great message to give, because it is a signal to speculators that bank regulators are going to do exactly what they appear to be doing, which is protecting their investments, doing what they can to prevent home prices from falling. The governments and banks can't control what is going on in the resale market, but they can obviously influence what is going on with these types of properties to keep prices elevated. And that is what they appear to be doing. And again, I think it is a problem if we think about where the housing market is going in the future. I mean, what is the role of the bank regulators? They have different rules for different people to prop up home prices. And I think that is a massive thing we should be concerned about, as citizens, because obviously it impacts our housing market both today and in the years ahead. Now, moving on, I think it's important to rewind the clock to think about, well, what the heck were investors thinking in 2020? Why were they paying $1,500 a square foot when they could buy an existing condo for $1,000 a square foot? Why was anyone doing this? I mean, and I think it is an important question to understand where we were and where we are today and what we can expect going forward. So if we rewind the clock back in 2019, condo prices downtown accelerated from about $617 a square foot to about $1,000 a square foot. So that's a 62% increase between 2015 and 2019. And in the same period, rents also shot up by 32%, 24 from 1866 to 2400. And again, a lot of this was Canada's boom in population, which I'm going to talk about, but this really stimulated the demand for housing and caused prices to skyrocket. Now, if we look at that period from 2015 to 2019, a couple of things stand out. Number one, Canada introduced a stress test on insured mortgages, which basically means anyone who had less than a 20% down payment had tighter qualifying criteria. They had to qualify at a much higher rate. And what that did was anyone who's looking at buying a starter home in 2016, all of a sudden got priced out of buying a low-rise starter home and got pushed into the condo market. And what happened is literally in 4 months, condo prices went from $450,000 average price to $550,000, $100,000 in 4 months. And this was right when the stress test was introduced. So a terrible policy decision. I mean, the stress test itself is good, but clearly not thought out how to be implemented because it fueled a rapid growth in prices. And again, I think this is important to think about. We think, or policymakers come off like they've thought about all these. They didn't. I mean, this is a very poorly executed policy change, and it stimulated growth and fueled the speculative mood in our market. Of course, that was largely a period of declining interest rates, which again fueled optimism and confidence in the market. Canada's population growth. I mean, in 2015, Canada's growing by about 287,000 people per year. By 2019, it was about 550, so we nearly doubled in just 4 years. Of course, this stimulated growth. And I mean, since then, our population is now growing by over about 1.2 million people per year. So we're practically tripled or quadrupled our population growth rate in a very short period of time. So this, of course, helped with the price acceleration, but fueled people's optimism. And then finally, the common narrative at that time was that there is no concern about high prices or speculation, that the only problem is that we're just not building enough homes. And when economists and housing experts are pumping this narrative, what they're really doing is feeding into the overconfidence of investors that they can pay whatever price that builders are asking, and it doesn't matter because home prices will be tomorrow because we have this supply shortage. So prices are effectively irrelevant because they'll just keep going up because of this. And this is, like I said earlier, this is largely the narrative in this private meeting I was at with policymakers, that these are not concerns. Like their only concern is how to build more homes. And of course, we need to build more homes. But there are other potentially structural issues going on in the housing market. When you have a speculative boom in condo prices, I mean, that is a vulnerability that is playing out now. So that's kind of what was going on in 2020. And we got to look at, well, why is today's condo market very different from the past? I mean, for starters, we did not see a 60% plus growth in condo prices over the past 4 or 5 years. Condo prices have actually been flat from 2020 to 2024. Condo prices have the exact same price per square foot. They have not gone up. And this is one of the reasons why we have a vulnerability. Canada's pre-construction market, Canada's housing market is really, the foundation of it is rising prices. It does not really work well if prices are flat, which is what we kind of need for some affordability, right? We can't have prices growing by 10% per year. because that's obviously not the path to affordability. And we're starting to see the vulnerabilities of our market when we have flat prices, that our entire pre-construction housing sector doesn't really work in a period of flat prices. It only works if prices are appreciating by 10% per year-ish. So again, that's playing out right now. The other difference, of course, is that we're in a period of much higher interest rates, and a period where interest rates are likely going to stay higher for longer. And that is going to weigh on investors' ability to finance and pay for these properties. Canada's population growth should likely decline, and that's what we're starting to see. Our federal government has indicated that they want to reduce the number of non-permanent residents, which would take our population growth from over 1.2 million people per year to 300,000, assuming they do what they say they're going to do. This will, of course, take some pressure off of housing and rent growth and price growth. So again, the sentiment is very different. We also are seeing that condo rents in the Toronto area are actually declining. And this has to do with a record number of completions recently that is putting downward pressure on rents. Now, looking ahead, the bigger issue is that the Toronto area has about 90,000 condominium units under construction, okay? And the units that are going to be completing in the next year and the year after, the difference between what investors paid and what resale prices are likely to be is going to be even wider. I mean, I don't think anyone realistically expects condo prices on the resale markets to appreciate very much soon, anytime soon. Listings that are an all-time high, so that it looks like we might even see a bit of a cool down. So again, the over the next year or two, investors who bought those units that will be complete in the future paid a much higher price than even 55 Mercer. So the difference is not going to be 10 or 20%. It's going to be probably closer to 30+%, which means, you know, a unit that someone paid, you know, $1,000 for is going to be worth 30% less when compared to about $1 million for is going to be 30% less when compared to existing resale units. So that is going to be obviously a far more challenging environment if, you know, the units that are completing are worth materially less than the resale market. And what will policymakers do then? I mean, will they continue to pretend condo prices are worth what the investors paid for them? So that's what we have to be mindful of. So when we think about what happens next in our housing market and what we can expect in the years ahead, the reality is it's really impossible to predict because a lot of this depends on both government policies and what banking regulators are doing. And I think this is a challenge where it's very hard to say what's going on. I mean, are the banking regulators doing this and kind of sweeping it under the mat and hoping nobody notices? Or is our government fully aware of what the banking regulators and the banks are doing and trying to turn a blind eye, but fully supports it? And we don't know. But ultimately, these problems are going to get worse over the next year and two. And I think as citizens, we need to understand what governments and policymakers and bank regulators are doing. Are they effectively propping up the condo market by changing banking rules for a certain segment of the buying population in order to protect their bad investments effectively? Or are they going to, you know, allow the market to play out the way it would if those people have to qualify and come up with the capital and can't, and they have to default on their property? So again, there's not these are not good outcomes. I'm not suggesting that, you know, allowing people to default is a good thing, but listen, when you had a market that was fueled on speculation, I think it's important to have a bit of a cleansing. I mean, people need to pay for the cost of their bad decisions. I think that is so important in a market that was fueled by speculation. Having governments paper over their bad decisions to keep home prices elevated results in bigger problems down the road. So yeah, we might suffer some short-term problems if governments step back and allow some of these projects to fail or investors to fail. But the consequences of brushing over them and propping up the market, I mean, I feel are actually probably worse socially and economically for the next generation. So a lot of this depends on how governments approach these issues and what policymakers and banking regulators do. So there's probably a couple of different possible scenarios. I mean, the first is the Banking regulators and governments don't keep doing this, and they allow some investors to default, which will lead to some distress sales, either individual units, and then potentially some distress in some condo projects that, if too many of the investors default, those condo projects could run into problems. And this again could lead to price declines if sentiment shifts. This is not different from what we saw, and like I said earlier, in many of the other cities and countries during the US financial crisis when their condo projects failed. Governments did not intervene to save them and save the investors' speculative investments. This is a very, uniquely Canadian approach to housing that wants to keep home prices as elevated as possible and save people from their bad real estate decisions. I don't think it's a very good approach, but it's the approach that we're seeing now. And I think we need to be mindful of what happens. So if governments change this direction and just allow the chips to fall as they may, yes, we might get some pressure and some distress and maybe a very negative shift in sentiment, which may lead to pressure on some of these condo prices. So that is one possible scenario. Another possible scenario is, of course, that we see no decline in prices because governments continue to do what they can to protect these sort of bad investment decisions to keep condo prices from falling, propping up home prices. And again, I don't think this is ideal. I think longer term, this has a lot of negative side effects. I mean, it's just going to fuel even more speculation, keeping home prices as elevated as possible. And I think in a government that talks about generational fairness, I mean, we have to ask ourselves, why is it generationally fair for the banking regulator to have different rules for one set of buyers than another to protect them, to effectively allow them to buy investment properties with zero down payment, 100% loan to value? I don't think that's fair. And I think if, if this is what governments do, I think it's important to hold the banking regulators account to what they are doing to prop up the market. I don't think it's reasonable to just sweep it under the mat, which is what everyone's trying to do now, and pretend it's not going on. And this is going to get worse. And I think it's important for everyone in the real estate industry to keep an eye on what the government's doing and what banking regulators are doing. Because there is a scenario where prices don't decline, where the government's prop them up. I don't think, again, those are responsible actions, but again, we have to be mindful that this is possible because this is effectively what they appear to be doing so far. So finally, I mean, I'm just going to end off with advice for buyers and sellers. And I think this is the hardest part because we don't know where the market's going. We don't know what banking regulators are going to do. We don't know what the government's going to do. Like we said, the one thing we do know is that the condos that will be completing over the next year and 2 years are going to be worth way more than the existing condos in the resale market. I mean, even if prices stay flat today, that will be the case. If prices in the resale market dip a little bit, that gap will be even wider. So there are vulnerabilities in that pre-construction segment. How those play out into the resale market, which is where most people are buying, so existing condos, is very hard to say because, like I said, it depends on what banks and regulators do with those future closings. Do they allow the market to potentially decline a little bit and see some distress, or do they paper over it? And I think that will be the important question over the next year or two. So, I mean, I think the important thing is to follow myself, follow other people in the real estate industry who are looking at these things. So we'll be talking about these things. I mean, I host a monthly market update on our channel, Move Smartly on YouTube, partly to talk about the things that are going on real time in the housing market. So, whether you're buying, investing in the future, I think it's important to kind of keep on top of these trends that, the governments aren't talking about, the policymakers aren't talking about, the housing experts aren't talking about, but it's sort of people in the industry like myself who are trying to unpack what's really going on behind the scenes, the stories that are not making the headlines because they impact our housing market, they impact people's decisions, they impact affordability in the future. So I think my only advice is keep an eye on these trends. I think it's important to educate yourselves on what's going on and to be mindful about how these trends and these future condo completions may impact the condominium market in the months and years ahead. So just to be mindful of all of these dynamics. I hope you found that helpful. If you have any questions, as always, you can post them in the comments below or just shoot me an email at askjohn@movesmartly.com.
Hi, John. So another episode of Move Smartly Ideas. This time to discuss your piece, which I really enjoyed about, the condo market and perhaps the propping up of some segments of it. And I think you're really getting at an issue that banks and our government might, something that they might be doing that we're not quite as aware of as we should be.
Yeah, I mean, definitely. I think it's this is an important issue. I think it's, really kind of touches on an issue that I've been kind of talking about, researching, and probably going to work on more, which is, really this shift in our housing market where, homes are no longer just houses for families or financial assets for investors and speculators. And then, of course, all of this has this ripple effect, obviously, and what governments and banks are doing to prop up sort of these investors in times like these. So, I think it's an important issue and something that most experts aren't really talking about.
So let's unpack this issue. Let's start with the basics. I want to make sure I understand the difference between the pre-construction or new build condo market and the resale condo market. So with
Yeah.
the pre-con, the former buyers are paying a deposit when they go to a showroom and look at a building layout that will eventually be built, and they
Hmm.
don't need to go ahead and qualify for a mortgage until 3 or 4 years later when that building and their units are completed.
Yep.
And that's different from the resale condo market, which is, a lot more familiar to us. When you're ready to sell your condo, you put it on the MLS like other homes
Hmm.
and invite buyers to make offers. Those buyers have to have their mortgages and financing lined up.
Yeah.
Is that correct?
Yeah, for the most part, that's the key thing. So, I mean, imagine you're an investor considering both. One of the big differences is if I'm an investor buying an existing condo, I have to have 20% of the purchase price today. I have to qualify for a mortgage today, right? That's one issue. Whereas, as you said, the pre-construction investor doesn't need to have 20% today. Their deposit structure is staggered over years. They might just need 5% today. So it gives them time to either save up the money, or if they're borrowing it, they don't have to pay interest on that debt from day one. The other issue is, when you're buying pre-construction, and resale, there's a slight difference. I mean, by the time you buy an existing condo to the time you get your keys, it's usually a short period, like 60 days. Not much is happening in the market, usually in that 60-day period, meaning prices usually don't change very much. Whereas when you buy a pre-construction condo, you're paying a price today for a unit that you're not getting for 4 or 5 years. And many things can, of course, change in that time period, including sort of the market value for condominiums, which kind of touches on what I'm talking about. So those are the two big differences, I'd say.
And most recently, a historic interest rate cycle hike can happen
Exactly.
in
Yeah,
those
exactly. During
intervening
that
years.
period. Yeah, exactly.
So, continuing on this basics theme, I recall it's been over 10 years when Velocity was launched and we launched Move Smartly. Uh, and I do remember even back then you were writing about something curious that you were observing in the condo market. And your observation there was that normally, a premium had to be paid for resale because there was, in other words, you would pay more for an existing condo than you would a pre-construction condo. But
Mhm.
about I think even by 2010, you were seeing an inversion of this formula where people were starting to pay more for pre-construction condos than resale. Now, why did you find that surprising? Like, why is that unusual?
In some other markets, I mean, you would typically pay a bit of a discount. I mean, not a huge one for pre-construction because there are inherent risks. I mean, the project might fail. You don't know what your finishes are actually going to look like. Builders have a lot of leeway when it comes to sort of changing the layouts a little bit. So you might not get the product that you were promised necessarily. So there are risks when you're buying a pre-construction condo. But what happened is years ago, the most buyers, I mean, despite what you hear some housing advocates say that, end users don't buy condos, there were quite a few people who were buying condos as end users 10 and 15 years ago. I mean, I mean, that was kind of when I got into the business on the sales side, and all of my clients who were buying were end users. They were buying a condo that they would need in 3 years to move into. But the market got sort of taken over by investors. Investors are a little bit more speculative, a little bit willing to pay a higher prices, and the prices kind of just escalated. And if you hear people in the building industry say, "Oh, it's just construction costs," I mean, not really just that. I mean, builders are pricing projects at the highest price people will pay, and investors are paying the highest price. So those prices between the disconnect between resale and pre-construction really widened over the past years. It was a lot closer 10, 15 years ago, but has really kind of widened quite a bit over the past 5, 6 years.
And why are so many investors willing to pay these premiums, these really high prices for pre-construction condos in the Toronto market? Why are they doing that?
Yeah, I mean, it's a good question. So, I mean, at the time, as I mentioned, when I wrote this piece, investors were paying 30 to 40% more than what a similar existing condo was selling for in the market at that time. Why would they do that? I mean, it's a fantastic question. It's hard to get into the minds of why someone would. I mean, I certainly do that. Many of the people I know wouldn't do that. But I'll give you some reasons probably why they would. I mean, number one, it is a more leveraged investment, meaning you don't need your 20% up front. You can stagger it, which means that you don't need, you're kind of the money that you're putting down is not as material from day one. It's, you're only putting 5% in year one and you're staggering those deposits. So it's effectively a little bit more leverage than buying an existing condo. But a lot of it is just this idea that you put your money down, you flip it on closing, you do nothing. You don't have to worry about tenants, you don't have to worry about renting or maintenance or anything. It's basically like free money, right? And this is, I think, the mindset of many investors who are buying pre-construction condos, that it's this just get rich quick scheme. And it was for a long time. I mean, people think it was, they're making so much money because of their genius investment decisions. I mean, we all benefited financially from the fact that our government decided to rapidly increase our population growth, which fueled rent growth and price growth. I mean, so these were the reasons why sort of condos largely went up in value. People just think they always go up this rapidly. So anything you buy pre-construction is a sure thing. You have agents saying, just buy pre-con, you'll make 150 grand by the time it's done. You don't have to do anything. We'll just flip it. And I think this is the mindset of many investors who are paying these premiums. Again, not every investor thinks like this. Some people are making decent decisions. Some projects are probably good investments, but some, of course, are quite risky and quite speculative, like the ones I was talking about back in 2020.
Right. So a lot of what was giving these buyers confidence is this: there's not enough supply narrative, which you criticize
Mm-hmm.
in your piece. And the idea that Canada doesn't have enough homes for all the people that need them is that so strange? Is that even wrong? We hear it from expert papers, government bodies like the Canadian Mortgage and Housing Corporation saying we need 30 million more homes for homes to be affordable. So the idea that we don't have enough supply over the longer term, I would think is not necessarily a wrong thing to believe.
Mm-hmm.
What I'm wondering is if experts aren't more to blame for confusing the issues of short-term supply and demand issues versus this longer-term backdrop of
Mm-hmm.
when you have a growing population, you will always need more supply, and we didn't have enough to begin with.
Yeah.
And what I mean by that is you just talked about a population boom, a
Mm-hmm.
record high population boom in the near term. So that's a demand surge. Now, on the other side, are we not told enough about the risks of supply surges?
Mm-hmm.
For example, we have a record number of new condos closing,
Mm-hmm.
meaning units of supply that are going into the market, whether for end users to sell or to be sold, to be used as rental units,
Mm-hmm.
sold to investors and used as rental units. Is it true that the Toronto area market can absorb all this supply at any moment? Like, is that really our demand supply situation?
So,
Or
I mean,
can you end
yeah.
up with too much supply sometimes?
So it's a great question. I mean, you can definitely have supply shocks, which is what we have right now in the Toronto area in the condo rental market. A ton of units got completed. This is why rents are trending down. Number of listings for sale are at a record high. Listen, I think the key thing is yeah, you can have short-term demand or supply shocks. We do not have a structural oversupply. There are two different things going on. We have a short-term flood of condo listings for rent. The issue isn't so much can we absorb the supply, because we can. It's, can the market absorb some of this future supply at the prices that people paid, right? And that's kind of what I'm getting at. We think about these 90,000 units that are still in the pipeline. Investors paid a really high price for those, way higher than what resale prices are going to be. So can the market absorb them at those prices? And the answer to that is probably no, because it, and again, I think this is the disconnect. And I think one of the issues I had with these economists that were just kind of pumping, effectively fueling the speculation. When you say that the only issue we need to worry about is supply, it really feeds into this enthusiasm that investors have, and it actually drives speculation. It drives this belief that it doesn't matter what price I pay, the market can absorb it. And these are the side effects of that narrative and these policy approaches that we're going to feel now, that the market probably can't absorb condos completing at 16 and 1700 bucks a square foot downtown when resale prices are 1100 a square foot, or 1150 or 1200 for existing units. And I think that's going to be one of the risks that we're going to see in the months ahead. So I think that's the important difference between when we think about the balance between supply and demand.
That's actually really helpful. And I think we need to start speaking about that in a more sophisticated way. That makes a lot of sense. So now we're seeing headlines about buyers getting into trouble as we're hearing about mortgage holders starting to come under stress. A lot of mortgage holders are now coming upon their, the need to renew mortgage terms. And as I mentioned, we've just undergone an historic rate hike cycle. We saw the bank cut a rate just earlier this month, but that's after a really fast increase in interest rates, one that many Canadians had never experienced before.
Mhm.
So some mortgage holders are getting into trouble. They're finding that they would reset at a monthly payment that would be really hard for them. Now, that's not quite the same as the buyer who is being helped with this blanket appraisal
Mhm.
issue. Is that different? Is that someone who's trying to get their mortgage for the first time for a newly built condo, or are these issues related?
They're kind of related. So yeah, a lot of people might be having issues affording their mortgages when they're renewing their properties. A lot of people obviously buying homes on the resale market today are having challenges getting in when interest rates are in the fives and they're getting stress tested at 7%. Okay, that's certainly one issue. Now, these investors have actually two issues. They still have that issue of qualifying at a 7% stress test rate. And I suspect they're probably getting some help from the banks on that front, because it would be very hard for someone who is leveraged, has an investment property or two, has a home, to qualify under our bank regulators' guidelines to take on so much debt at these elevated interest rates, right? So they're probably getting some help just on the qualifying is one thing. But the other thing is they're probably getting some help on the value, the appraised value that I'm talking about, that the banks are kind of ignoring what those units are actually worth, pretending they're worth what the investor paid for them, even though they're probably actually worth 20% less, which obviously potentially exposes the banks a little bit as well, because there's a very little equity and capital in those properties. And again, I think, as I said, a lot of this is banks trying to avoid what could be really some big issues if too many investors don't qualify and some of these condo projects run into financial stress. So there are two slightly different issues when it comes to the pre-con investor qualifying versus resale.
Right. So even if we are looking at a specific set of condo buyers, when we run into this blanket appraisal issue, can banks and governments help them indefinitely? Like, what if the demand is too great out there? Is there a point at which they can't do this forever? And if they can't, and they start to have to make their books make sense, right? Because banks also have to prove that they're holding their loans in a responsible way. Eventually, can this stop? And if this stops, is there a risk that other parts of the real estate market are also at risk for price. I guess people would have to cut prices, so
Yeah.
is there the risk of that?
So yeah, 100% there is that risk. Like I don't know if banks can kind of go on and do this indefinitely. I think right now they're seeing what's happening. They're probably doing these to avoid bigger issues while they figure all of this stuff out, quite frankly. I suspect is what's probably happening. And they're looking at what's coming down the pipeline and trying to come up with a plan on how to deal with this. Because again, like I said, and this wasn't even me. I mean, I was at a conference, Sean Hildebrand from Urban Nation talked about this bigger risk with these future completions that are going to be worth a lot more than resale as we go into the years ahead. So as that happens, can a bank just have a blanket appraisal when, a unit is worth 30% less than what the investor paid for it? I mean, banks start running into problems if there are too many investors. They can maybe do a handful of those on a 500 unit project, but if half of the investors are buying units with negative equity, meaning like the mortgage even exceeds the value of the property, the banks are going to obviously have their own concerns about doing that. So I don't think they can do that indefinitely. And I think this is why I raise this. It's important to understand as consumers, as citizens, what banks and governments are doing over the next 3 years in the condo market, obviously, because it affects everybody. So, so I do think there are risks there because can they do it? Can they come up with some other schemes? Can the lender take out second mortgages? I mean, there are a lot of different scenarios that the banks and the builders can do, but I don't think I would be surprised if the banks continue to do this as the spread widens, because again, it kind of obviously exposes them to a lot of risk as well.
And to clarify, it's not just the investors who maybe can't get that mortgage. If enough of these units pile up in a building, are the builders at risk as well? Because
Well,
these
yeah,
projects are sold in a certain way.
yeah, that's the big risk is that the project fails. And like as I said in the video in the segment, I said like this is what happened during the US financial crisis. And a lot of cities where investors were buying up all the condos, in Las Vegas and in Miami and in Dubai, there's just like these speculative frenzies. Many projects just failed and canceled because just the investors just walked away. Said, I can't do this anymore. You can keep my deposit. I don't care because it's worth 40% less than what I paid for it. So you can keep the 20%. So, so the projects could fail. And I think that is the risk that lenders, banks, and builders are concerned about. And it's a legitimate concern. I mean, it's not an ideal outcome for projects to fail. I mean, that's certainly not what I'm suggesting. But obviously, there are downsides to different approaches. Banks obviously trying to sweep this under the mat indefinitely is also not a realistic solution either.
So, what we saw in the States is in Las Vegas and some of these other areas where this new build had just gone, this tremendous boom. When
Mhm.
the air came out of that, not only were investors walking away, but then we did see regular families being hurt, right? Those that had maybe bought into the project. Or is it even possible that if you're in an area where a lot of new condos are being sold and are going up, could people even in other buildings in other condos face a risk of price cuts in their market, like a contagion?
Sure. I mean, sure. That's generally what happened. I mean, prices plummeted in those very speculative markets. Um, so here's the thing. I'm not as bearish with when it comes to Toronto's market. Like, I don't think we're going to see those dynamics. The one big difference is in those markets, they had a lot of overbuilding, right? So when we talk about structural supply shortage or excess supply, they had an excess supply, right? Because they were building more than they needed. So they had this inventory sitting on the market. We're not going to be in that situation. We're going to have an excess supply of extremely high priced units that no one can afford at that price. And the price of those may drop. But I don't think we're going to run into the same issues. Like I think if we see some side effects in the resale market, it's more because of sentiment. But Toronto's not overbuilt, right? And I think that's a very big difference from some of those other markets. Why we're not, I can't predict, but we're probably not going to see like a 50% decline the way some of those cities saw when prices plummeted. They had huge price corrections. And I don't see that happening. Obviously stress in these newly completed pre-construction projects can have a slight side effect on resale. But again, I think the issue is more that those new ones are just too expensive, right? And again, I think those segment is probably gonna feel a little bit more pressure than the existing resale market, which I should say, obviously the resale market is feeling some pressure now. We have a record number of active listings. So there are some vulnerabilities there. I just don't think they're going to be as significant as we saw in some of those other markets.
Sure, but some introduced vulnerability. And, you've been writing that for many years, for decades, neoliberal economies like Canada have sort of, landed on this way to provide rental housing, which is to allow builders to build, rely on private sector investors, whether it's, smaller investors owning a couple units or families or family companies owning, 10 units and up, going in and buying them and then turning them into rental supply. And this was seen as a great thing. In fact, you recently spoke to a guest on our show, Murtaza Haider, hopefully I've said that right, of TMU, University in Toronto, who says this is a great way to, the most efficient way to supply rental housing. A lot of those economists also argue, keeping rent controls off and allowing that building and investing cycle to continue as freely as possible is the way to go. But I'm wondering if Hyder and others are missing this other thing, that when you have these smaller investors involved in the real estate market that way, you're introducing financial instability in a new way, because all market cycles, where smaller investors can move in and out, are subject to boom and bust, right? We see this in stocks, we see this in other areas. So, are they kind of glossing over the increased risk that strategy is introducing?
So that's a great question. So before I answer it, maybe I'll just briefly touch on what you mentioned about kind of Canada's neoliberal housing market, because it might be a little bit inside baseball for people. So when I talk about that, in most of the academic literature, that we're talking about like the housing regime, the way our housing economy is set up, the way housing, the role it plays in our society and our political economy, right? So for example, the best way to see this is probably through the rental market. In a lot of European countries that are not as neoliberal or free market, that's what you should think of when you hear neoliberal, just sort of free market, no barriers, just do what you want kind of economy. In many of those economies, the rental market is a lot of it is actually non-for-profit rental. Some of it is geared to sort of lower income. So they have a far bigger portion of their rental market that is non-market housing. So market housing is sort of free market, charge whatever you want. And then we have non-market housing, which is obviously a little bit more geared towards affordability. So, that's what we see in European economies. A lot of Southern Europe, that, 90% home ownership rate because everyone lives together. So their whole market housing structure is completely different than even some of the Northern Europeans. So there's just different ways that housing works. So Canada is just very leave it to the free market. One of the reasons why condo construction and mom and pop investors explode is Canada got out of the business or prioritization of actually thinking about housing in the 90s, right? Canada said, you know what, we're in a bit of a bind here. We don't have enough capital, so we'll just let the free market figure out how to build homes for people. So what happened is we just stopped building permanent rental housing. And basically the government said, well, let you guys figure it out. We'll let sort of mom and pop investors basically drive, what the rental market needs. So, condo builders started building condominiums that were bought by mom and pop investors who started leveraging their homes. And this is a bit of obviously a cycle that everyone's sort of using the existing equity of their home, their assets, to, obviously invest further in housing, which contributes to sort of this financialization and boom. But to your original question, yes, 100%. When you have a housing market fueled by the whims and optimism and speculation from mom and pop investors, you open so much, risk to the market. And this is kind of what we're seeing now, because the mom and pop investor is not rational necessarily. I mean, we think they are, they think they're making rational decisions. But listen, institutional investors would not build rental housing at the price that mom and pop investors are paying because the numbers don't work. They look at what the rental income is going to be on completion. They're like, I'm not making money off this. The mom and pop investor is willing to do it because they think prices will go up forever, not because they're doing any sophisticated math to think about their cash flow and their rent. They just think it doesn't matter. I'm paying $1,700 for a pre-construction condo in 2020 because it's going to be worth 2,100 or 2,200 5 years from now because real estate always goes up. This is, the motivation of the sort of the mom and pop investor. And again, obviously not all. Some are, I don't want to criticize. I know some mom and pop investors, some are very sophisticated. Most are not, which is why we have sort of these risks. So 100%, it's not a good way to build housing. Would have been a lot smarter. And why I think it is better for governments to encourage builders to build permanent rental housing because it's permanent rental stock. And it's not sort of driven by the whims of speculation, which obviously, as we're going to see now, is going to create some vulnerabilities in the housing market.
So you have indeed advocated that, government should look at low cost loans to builders and other financial incentives. But you've also written that builders are not they're in the business of building. They don't want to stay around and become landlords. So if we're less reliant on this smaller investor, this mom and pop or mid, that kind of investor, aren't we running into another risk, which you started writing about a lot, which is these huge institutional investors, these corporations from the US, even some in Canada, buying up tons of housing stock. And now you're just transferring sort of the idea of renters being, beholden to one group, which may be very volatile. And now, running into the arms of another group, which are these huge corporations that could have a lot of control over their rents and their conditions.
So I think we need to unpack that a little bit. So when I talk about my concerns about big corporations kind of buying housing, I'm specifically talking about largely, housing that was built to be owner occupied. I mean, think about sort of our existing semi-detached to detached townhomes in all the neighborhoods in Southern Ontario, right? These were homes that were intended to be bought by families to be used as a long-term investment for their retirement, where they have security of where they're going to live for the next 20 years. So I think it's bad that our governments and virtually every economist is advocating that, yeah, it's perfectly fine if REITs, real estate income trusts, come in and buy all that stock. We need more investment. They're calling that investment into housing. It's not investment. They're just land hoarding and taking advantage of our housing shortage. So I think that's terrible. Most experts think it's fantastic. And which is why they don't advocate for doing anything against it. That's completely different from what you're talking about. Now, when we're talking about, we need investors to build rental housing, right? And if it's a big corporation that's coming in and buying in a 100-unit apartment building, that's who's buying them. Like it's REITs and corporations that are buying rental housing. So I think it's certainly better than relying on sort of the whims of mom and pop investors. Again, it's the difference between building permanent rental stock, purpose-built rental, the way we were building in the 60s and 70s, versus these one-off micro condos, because that's what every individual mom and pop investor can afford. I don't think that's the way forward. We need more permanent rental housing, less mini condos bought by mom and pop investors. But on top of that, we also need more non-market housing, right? And non-market, and the government, federal government, to their credit, are starting to do that. Sean Fraser announced that the federal government's really amping up on building co-ops, which they we haven't done in decades. So that is like another example of non-market housing. That's the type of housing that is going to be affordable. That's not meant to be sort of this cash cow, so I think we need more of that, but certainly we need investors. And I think that I'm actually advocate for that government should do more to help investors to build rental housing. Like some of the things that they did in the recent budget isn't enough, and I think there's a tension here. Progressives see this as like a giving money to builders, but if you want to, sort of, if you want a certain type of housing stock and it's not profitable, you have to give government incentives to get builders to make that. So if we want more permanent purpose-built rental housing rather than micro condos bought by mom and pop investors, we have to make the former more profitable so that builders can do that. So we need even more incentives to do that.
So you're actually touching on our need as Canadians to think a little bit more sophisticatedly, nuanced way around investors. What do we allow investment in what segments of the market is what you're really talking about? And what are the
Yeah.
different needs of the different actors in the market? And to your point, am I right in understanding that the 60s, 70s, and 80s rental buildings that many Torontonians are living in right now are actually run by large corporations? I believe Germany developed an expertise in this, and this probably relates to the point you're making about Europe, where this expertise in owning and managing large rental buildings developed because that's the society, the structure of the housing in a lot of their cities. So am I right in thinking that these large corporations are already in operation in Toronto? It's something that we just don't think about.
Yeah, 100% they are. And I think, I think a well-functioning market needs corporations to own rental housing. I don't think that's different. We need more non-market housing. And you're right, we need to be a bit more nuanced. I work with investors. I am an investor. I'm not saying we obviously need investors to build housing. There's a difference between a corporation that just buys single family homes and sits on them and does nothing and collects rents and capitalizes on our housing shortage and is speculating on land versus investors who are buying houses and converting them to 4 or 5 plexes. Okay. That's a good type of investment because it actually builds housing. Sitting on homes is just not the type of investment we need. So I think we need to be a little bit more nuanced when we think about the role investors play in our housing market.
The way I've started to think about it is thinking about the investor that's lining up for the product they're aiming for against an end user. Are they just using their muscle? Like in Southern Ontario and all these smaller towns or suburbs of bigger towns, there are lots of people who want to raise their families, over 20 years in this home and then use it for their retirement. So that's the end user. And investors lining up to buy up these subdivisions against that user versus renters who are not in the position to have the cash to even buy a home, young professionals, people struggling to get back into the market, newcomers to Canada. They're not in the position to be an end user in that way. Exactly. So, if you're lining those people up against an investor who's now going to invest in a housing project or a co-op or things like that, that's a different type of investor. Am I right in starting to think that way?
Yeah, we need exactly. We should not have Bay Street corporations competing with families for the same type of housing. And the only reason it's reasonable to allow that is if those people are buying those homes to build something bigger, right? If they're just going to sit on a single family home, we shouldn't allow it. It blows my mind that most housing experts, housing advocates, think it's perfectly good way to supply rental housing to have REITs buying up our existing family-sized homes and just renting them out. I mean, I don't. I guess maybe I'm not as free market in them. And housing's not a pure free market, just to be clear. Like in most countries, there are restrictions. Rent control is one example, as I said. So it's not a completely free market. There are usually regulations, but there are regulations that are geared towards making it more affordable for citizens. That's the whole point of policies around housing and why it normally isn't a completely free market.
And more to your point, the whole point of the piece that you just shown, the presentation on the condo market is even governments and banks aren't acting in a free market way if they're doing these slide arounds and trying to prop up condo prices with blanket appraisals, right? Like that's not free market either.
Well, exactly. I mean, that's it. That was kind of the point that I made. And it's like, we can't talk about as a free market when you're bending the rules, when you're bending banking regulations to accommodate one set of group that you just want to kind of help because, you don't want a particular condo to run into challenges. So that is also not free market. You're 100% correct.
All right. Well, I suspect we're going to be hearing a lot more on this larger issue of financialization. I found it really eye-opening and I look forward to hearing and talking to you more on this.
Sounds great.